Hi, welcome to watch the sixth video of corporate finance. Today's topic is estimating the cost of capital. Today's video contains four parts. 1. The equity cost of capital. 2. The debt cost of capital. 3. A firm's cost of capital. And 4. Risk characteristics and financing of a project. Let's get started. We have introduced the capital asset pricing model in the third video of corporate finance. There we have described the capital asset pricing model equation for the expected return of any security. So the cost of capital of any investment opportunity equals the expected return of available investments with the same beta. When using the capital asset pricing model equation to estimate a firm's equity cost of capital, the estimation boils down to identifying the market portfolio, calculating the market risk premium, and estimating the equity beta. The market portfolio is the total supply of securities. The proportions of each security should correspond to the proportion of the total market that each security represents. Market capitalization is defined as the total market value of its outstanding shares. A value-weighted portfolio like the market portfolio, in which each security is held in proportion to its market capitalization. If we focus our attention on the US stocks, then rather than construct the market portfolio by ourselves, we can make use of several popular market indexes that try to represent the performance of the US stock market. For example, the S&P 500 is an index that represents a value-weighted portfolio of 500 of the largest US stocks. There are also indexes that are price-weighted portfolio. In a price-weighted portfolio holds an equal number of shares of each stock, independent of their size. After having identified the market portfolio, the next step is to decide on the risk-free interest rate. The risk-free interest rate in the capital asset pricing model equation corresponds to the risk-free rate at which investors can borrow and save. In practice, the yields on the US Treasury securities are used to determine the risk-free saving rate. Taking into consideration of the difference in liquidity, the rates from the highest quality corporate bonds are sometimes used. It is also very important to match the maturity of the interest rate to the investment horizon. After having decided on the risk-free interest rate, the next step is to estimate the market risk premium. There are two approaches for estimating the market risk premium. The empirical approach is to use the historical average excess return of the market over the risk-free interest rate. The fundamental approach is to solve for the discount rate that is consistent with the current level of the index and an assessment of firms' future cash flows. In this slide, we will talk about the estimation of beta. Beta measures the sensitivity of the securities returns to those of the markets. Alpha measures the historical performance of the security relative to the expected return predicted by the security market line. For most of the firms, beta remains relatively stable over time, but alpha has very little persistence. Therefore, in practice, beta can be estimated based on the stock's historical sensitivity. Typically, These data sources estimate correlations and volatilities from 2 to 5 years of weekly or monthly returns and use the market index as the market portfolio. Practically, it is to apply linear regression to historical data to identify the best fitting line in the plot of the security's excess returns versus the market excess return, and the beta corresponds to the slope of this best fitting line. A firm's debt cost of capital is the cost of capital that a firm must pay on its debts. We have two approaches that can be used to estimate a firm's debt cost of capital. The first approach is to use the yield of maturity of bonds issued by the firm. So if there is little risk that the firm will default, the bond's yield to maturity can be used directly as an estimate of investors' expected return. However, if a firm's probability of default is not negligible, then the expected return can be estimated as yield to maturity minus probability of default multiply expected loss rate. Alternatively, we can also use the capital asset pricing model to estimate the debt cost of capital. Because loans and corporate bonds are traded infrequently, so in practice, we can rarely obtain reliable data for estimating debt betas directly. Instead, the debt beta can be estimated by using stock price data or using estimates of betas of bond index by rating category. After having calculated the debt cost of capital and the equity cost of capital, we can calculate a firm's asset cost of capital or unlevered cost of capital, which is the expected return required by the firm's investors to hold the firm's underlying assets. It is the weighted average of the firm's equity and the debt cost of capital. In contrast to the asset cost of capital, the weighted average cost of capital is based on the effective after-tax cost of debt. Similar to a firm's asset cost of capital, the beta of a portfolio can be calculated as the weighted average of the betas of the securities in the portfolio. When a financial manager evaluates a new investment, the difference between project's cost of capital should be accounted for. For multi-divisional firms, divisions are likely to have very different market risk. Even with a firm with a single line of business, some projects obviously have different market risk characteristics from the firm's other activities. The degree of operating leverage is also another important factor that can affect the market risk of a project. The degree of operating leverage is the relative proportion of fixed versus variable costs. So holding fixed the cyclicality of the project's revenues, a higher proportion of fixed costs will increase the sensitivity of the project's cash flow to market risk and raise the project's beta. Thank you for watching the video. Have a nice evening.